Let's get into a little bit of this idea of relative strength. And you mentioned the Russell 2000 to kind of start. And it's interesting that, there's two elements here that we have to discuss to make sure that everyone kind of understands what we're talking about. Number one, the relative strength line, which is comparing a particular instrument versus the S&P 500. Of course, in Market Surge, you can set that to other things, but the default is the S&P 500. And then there is the RS rating, which let's go ahead and pull up IWM. That'll give us a rating. IWM, you see a relative strength rating of 77, meaning that compares it to all the other companies and instruments, ETFs, everything in our database. So, Mark, when you're using relative strength, how are you using this to kind of gauge where you're going to be moving your money?
I tend to put most of my trades that I take are in names that are in the 90s in the relative strength, just by default. Not all of them. Occasionally, I go below. I used to have basically a cutoff of 89, and then below 89, I really require the fundamentals to be stronger. I need to know more about the situation, and I just get a bit more careful the more I go down in relative strength. And the next tranche down would be to get down below 80, you get into the 70s, and below 70, I pretty much want to stay away. So the 70 would be the cutoff, but 90% of my trading is done in names that are 89, 90, and above. That's just simply from a qualifier, just to qualify names, narrow the market down to a shorter list, and be in the better names, the names that are performing. So just real quick, tell you, how I got to using, I'm really a bottoms up approach where the stocks really guide everything I do. 90% of what I do with trading is guided by how the individual stocks are acting. But it didn't start that way. When I first started, I was a quant, which means that I would form a macro opinion and an opinion of the market. And then once I got a bullish opinion of the market, I would start looking at groups. And then from there, I'd look for the best groups, and then I would look for the best stocks in those groups. So what happened was, by the time I formed that market opinion and I got to those groups, I would look and I'd see all these stocks that earlier were set up perfect to my criteria, but now they were up way above the buy points. And I said, why did I miss that? The reason I missed it was because I was doing things backwards. The leading stocks lead, and the stocks will bottom ahead of the market. The better stocks will bottom first. So while the market's, even sometimes in a bear market, it's making new lows, you've got the leading stocks are making higher lows, and they're turning already into uptrends. So what I did was I flipped the whole thing around. I said, okay, you know what I'm going to do? I'm going to go stock first. That's going to lead me to the groups. And when I'm finding stocks and I'm finding groups, well, that means the market's pretty good. And everything changed. That went from the 1980s. My first trade I made was in 1983, Alice Chalmer. That was my first stock I bought. I did very poorly for 5 or 6 years. I did okay in 1989. Then 1990 bear market, I started having an idea of what to do. And that's where I caught Amgen and US Surgical and Microsoft and all these names that at the time were small mid-cap names that not too many people knew. And I started doing well. And then in the mid 90s, that's where, I did really well. And Market Wizards, Jack Schwager got a hold of my performance. And that's where people have read about. I started to know what I was doing at that point. But what got me to that point of doing really well was flipping that whole process upside down or backwards and and that's what I do to this day. So relative strength is like the first cutoff. If the relative strength's not there, if the stock's not performing, this goes right back to the rule I said before. Never trust the numbers, never trust the story unless it's confirmed by the price. So the first confirmer, if you will, is the RS. If it doesn't have the RS, it doesn't matter to me what the numbers are. It can have 500% earnings this quarter in sales, and everything looks great fundamentally. But if it doesn't have that relative strength, then I'm not going even to be interested in it. And then from there, it has to be in an uptrend. If it's not in an uptrend, this is in my book, the criteria for I call a stage 2 uptrend. This isn't my invention. This goes back to Wyckoff and my good friend Stan Weinstein, who basically wrote the book on this stage analysis. I met Stan in 1990, and he basically changed my trading at that point. I didn't have that rule, and I met him in New York City. We had lunch, and to this day, Stan and I are great friends. We talk all the time, and those are the qualifiers. So it's got to be in an uptrend, got to have that relative strength, or I'm not even interested in looking at the stock.
Mm-hmm. So Mark, with the relative strength rating, especially, so say you're looking at the Russell 2000 and trying to find a small cap name that could be going, a lot of times, especially those who are new, they'll wonder, the RS rating's already a 99. Haven't I missed it at this point?
Mm-hmm.
Generally, what do you say to people when they ask that type of question?
So it's a little tricky, because that's true that a 99 could be indicative of a stock that's made a big move, and you can top at 99. You top usually, at the strongest, you're gonna at some point reach the peak. That's where there's other parts of the analysis that come in, but this is relative. This is a relative rating. So you can have a stock that goes sideways while the market goes down, and the relative strength will improve, right?
Mm-hmm.
So and that could ratchet up to a 99 just by not going down very much, or even going down less than the market. Let's just say the market goes down, the Dow goes down 35%, and the stock goes down 5. That's going to really pick up a lot of RS. So here's my general rule of thumb. When the market's in a bear market, when we're in a bear market, I want to go for high 90s. I want all high 90s, 99, 98, 97, all the high 90s, because during that bear market, you're not getting stocks that are making big moves. They're picking up relative strength because they're resisting the downtrend, and it's like a spring being loaded. Now, when you get into a bull market where you've been going for years, and now you have a stock that's a 99. Let's just say Nvidia or some one high flyer. It's been going for a long time. Now you're on your fourth stage base. Now you have to start. It doesn't mean you don't buy it coming out of a base if it's a 99, but this is where cutting your loss is even more important, because now you get to the 50-80 rule, where once that big leader tops and you get a secular top, it's going down most likely 50 to 80%. So that's everything in the market is. Context is everything. It's really important to put things into context. But regardless of where we are in the cycle, I'm never lowering and saying, "Oh, we're late stage in a bull market. I'm going to go with 70 relative strength and avoid 99s." Never.
Mm-hmm.
I live and die by the RS sword. I live and die by the stop loss.
Yeah.
I made a decision a long time ago. I'm going to traffic in the best names. This is what Livermore did. And it's the same. This is what O'Neill did, David Ryan, myself. I'm going to trade the best names. And if the best names can't do well, then how good could the market be? And the other thing, I made a decision. This was in the late 80s, after I got chopped up holding some stocks. I said, I'm drawing a line in the sand. I'm never ever allowing a stock to go down and create a big loss for me, unless it gaps through my stop, and then I'm just taking the next best price. But they're gonna have to beat me one stop at a time and nick me to death. And I've never ever broken that rule in 30 some odd years, and the rest is history. That's when all my great performance happened.
Mm-hmm. Right. Now, I want to just kind of go back to the relative strength idea, because yes, there are those companies where they're very high relative strength, and you have to look at the chart to determine, are they extended and everything. But what about on the other side, especially because you've been talking about these rotation plays potentially? Do you get a situation where, if there's a rotation, you might have stocks that haven't been participating, and so the relative strength might be a little bit poor on those? How do you kind of decide on on a rotation play where to go?
Look, hindsight is 2020. Of course, you can go and look back and say, well, the stock bottomed when it was a 2 relative strength. That's true, but like I said, somebody wins lotto every week, but every week the name is different. Trading stocks, you have to develop a method that is something that you can duplicate, and you can have some reliability, and not where it's a shot in the dark, like throwing a dart, and it's going to happen once in a while. Can you identify that and consistently, have a strategy that produces X amount of gain, so you mathematically can manage your risk in relation to that? I haven't found a way to pick bottoms and tops. So the bottom line is you have to give up. If you're a trend follower, you have to give up picking below to make sure that the stock is in an uptrend. But what I have found is that it's unnecessary to pick bottoms and tops. And that's what's really important. I just said to myself, what is necessary? What do I have to do to get to my goal? My goal is to make big returns with very little risk and do it consistently and build wealth. And my thinking was, what is necessary to do that and what's unnecessary? So I threw out all the unnecessary stuff. Then it came back to just looking at the O'Neill studies, the Love studies, going back. We did our own studies. I did big, long studies of the biggest winning stocks. What we found is that the biggest winning stocks, before they make their big move, are already up 350% on average. So again, the data bears out that you don't need to pick lows. Also, think about this. Let's just say you could get the exact dead low. Let's just say you're in a stock gets pummeled, it's down 50%, right? You buy the exact low. Okay, so now that stock goes all the way back up to its old high, which means that it has to go up 100%, right? Tops at 20, goes down to 10. You buy it right at the low, it goes back up to 20. You've made 100%. Well, if that's going to be the next Amazon and go up 80,000%, what has to happen? It has to make new highs all the way in an uptrend. That's right. So you're not. There's nothing. Buying the low is irrelevant if you're going for that big move. So everybody's so infatuated with buying stocks that are down, but it's just simply unnecessary. And if you're making a big move in the stock, that low is only the tip of the iceberg. Even if you bought, and nobody's going to buy the dead low with precision and accuracy and consistency. But even if you could, a recovery back to the old highs, even if the stock is down 60, 70%, is only a couple 100%. And the data says that the average big winner goes up 350% before it even becomes a big winner. And I don't want that smoothing effect where I own the group. I want the best stocks in the group. And usually in any group, you've got some groups like the oil group or the semiconductors. Those are big groups. There's lots of names, hundreds of names. It's hard to pin down just a few names. But in most groups, you can narrow it down to 2, 3, 4 stocks that are the key leaders in those groups. Even just branding wise, you think branding, if I said to you, hamburgers, what would you say? Probably McDonald's. Right away. Boom. If I said to you home improvement, you're going to know Home Depot, Lowe's. If I said to you colas, what are you going to say?
Coke.
Coca-Cola. What's number 2? We're going to say
Pepsi.
What's number 3?
Dr. Pepper Snapple, right?
Yeah.
What's number 4?
RC Cola.
See how it gets harder?
Right.
So as you go away from 1, 2, and 3, it becomes exponentially harder to pinpoint a leader in any industry. It's just, that's just the way it is. They call it in marketing the law of duality, or where it really comes down to just a couple companies. So that's what you always have to think about when you're investing with stocks, is that you're looking for the best merchandise. You're looking for those really, really great companies, especially if you're going for the bigger move. If you're going for the bigger move, this is really important. Earnings, sales, leadership position, scalable business models. This is important stuff. If you're trading very short term, well, then it's more of a technical nature. Your trading is going to be more of a technical nature, because you're not going to be sitting through earnings reports. You're grabbing stock price moves that every stock goes up 10%. All right, so now it's just a matter of timing the shorter term wiggles with the stocks. But again, if you're going for the bigger moves and you're more of a traditional O'Neill type investor, O'Neill would add to his positions from base to base and build big positions. And that's how he made his money. I made my money. I started off building big positions like that, but I found for me, I found it was easier and that I could do it more consistently and deliver big returns year after year if I also brought in that shorter term trading and trade around my positions.
Yeah. Yeah. And definitely Bill O'Neill, when he started, it was kind of what you were talking about from the 80s,
He
it
had no
was,
choice.
yeah, exactly. It just, that's what it was, right? You weren't going to be
Yeah.
doing, swing trading because
But
as
I
you mentioned,
could
all
tell
the
you
mechanics.
this. But I could tell you this. I guarantee you this because I've met Bill many times, and of course, David Ryan was my right hand man there for almost a decade. That doesn't mean that they're not out of those stocks in a second if they
Right.
move.
Oh,
Don't
absolutely.
long. Yeah, I always tell people long-term investing doesn't mean long-term holding losses.
Yeah.
You should be a long-term investor and a very short-term loser. I have no, like, I'm not against, people say, Mark's a short-term trader. He doesn't, he's against, holding stocks. No, I'm not. I'm against holding losses. If the stock's performing, great, stick with it. You might have a big winner. And as long as it's performing.
Yep.
But what you want to do is create asymmetric leverage. And that means that you cut off the bottom side and you expose yourself where you've got big upside.
Right.
And you're not going to do that by buying crappy stocks that are at 52-week lows and aren't performing. That's just hoping and wishing that things turn around in a company that may never turn around. But when it's right in front of you and they're delivering, this also goes back to the studies. Everything can go back to the factor model studies with O'Neill and going back to Love, who wrote Super Performance Stocks. The earnings are generally on the table 70% of the time. Earnings are already on the table before the stock makes a big move. So you don't have to guess. So once again, it's what's necessary. People are trying to guess and front run everything. You don't have to guess. 70% of the companies have earnings on the table already for several quarters. So you can wait. You can wait to get that confirmation.